Good evening. Welcome to Accounting 101 Synchronous Seminar for Chapter 9. This chapter talks about liabilities. We talk about the difference in current and contingent liabilities, about bonds payable, notes payable, and interest expense. We talk about the difference between financing with debt and equity. We want to understand other types of long-term liabilities that a company may have, and then how do we report all of these liabilities. If you have any questions as we go along, just type your question in the question box and I will respond to those questions instead of waiting till the end. Okay. The first objective that we'll talk about are how do we account for current and contingent liabilities? And in fact, what are contingent liabilities? So current liabilities are obligations due within 1 year or within the operating cycle if your cycle is longer than a year. There are two basic kinds of current liabilities. There are known amounts and there are the estimated amounts of liabilities. The known amounts are the things like accounts receivables. Estimated amounts are things like potentially we may estimate our property tax expenses as we move forward, how much we will owe at some point in time. So here's some more examples of current liabilities of known amounts. We have the accounts payable, short-term notes payable, sales tax payable, accrued liabilities, payroll liabilities, unearned revenues, and the current portion of long-term debt. Keep in mind that some debt, such as mortgages, will have part of them being current. The first 12 months or the next 12 months that would be due would be current liabilities, and the remainder of that mortgage would be a long-term debt. Accounts payable, we should know this by now. This is strictly a review at this point, that these are amounts owed for products or services purchased on account. It's a common transaction when we purchase inventory. We had seen some of these ratios before, but accounts payable turnover is an important measure of liquidity. Remember that liquidity is the ability to pay your bills as they come due. Okay. It measures the number of times a year a company is able to pay its accounts payable. The accounts payable turnover is calculated by taking your purchases from your suppliers, the ones on credit, and divide that by your average accounts payable. We can illustrate this in a T account of where these purchases would come from by looking at our inventory account. It would be our beginning balances less any cost of goods sold, less our ending balance would give us what our purchases were. So beginning balance plus purchases minus cost of goods sold equals ending balance. We looked at this a lot in Chapter 6 in the inventory chapter, how cost of goods sold would affect. So purchases from suppliers divided by your average accounts payable. And then you must express that in the number of days. There are 365 days in a year, so we divide 365 by the number we computed for the accounts payable turnover. We have short-term notes payable. Short-term notes are due within a year. A note is a written promise to pay. That's what makes it different than an accounts payable. You use it to borrow cash or to purchase an asset. A company must accrue interest expense or interest payable at the end of the period. So if you have a car payment that is a note, you have signed a note for that car payment. That's probably not a short-term note, but you have signed a note. You might sign to buy furniture on account, and that is due in 12 months, and that would be a short-term note payable. Here's an illustration of the journal entries to record a purchase of inventory using a note. Instead of recording it as an account payable, we would simply record it as a note payable. Payable is a liability. Liability is the increase on the credit side. Inventory is an asset. Inventory would increase on the debit side because of the rules of accounting. If at the company's fiscal end, on September 30th, the company must accrue interest expense on the note that it had recorded starting in January. They have 10%. Their note was $8,000. So we would take $8,000 times 10% times 9 months, because January through September is 9 months, and divide that number that we calculate by 12. And that would give us $600 interest expense to accrue. Accrue means we are not paying it. We are just recording it on the books to update our records before we prepare our financial statements. And then we would increase our payable. If you remember, every adjusting entry included at least one income statement account of which interest expense is, and one balance sheet account of which interest payable is. The following entry records the note's payment at maturity. If we want to record a short-term note payable once it matures, mature means its due date. At its due date, we would need to zero out or remove any balance that we had in that note payable. We would have to remove anything that we had in the interest payable account. We have to record the remaining interest expense for the remaining 3 months, and we have to pay the cash. So we remove the $8,000 from our note payable. We remove the $6,000 from our interest payable. These are both liability accounts, increase on the credit side. If they would have had the balance of $8,000 and $600 respectively, we zero those out by debiting them. We would record our additional 3 months of interest, $8,000 times 10% times 3 months divided by 12. And then total that up for the total payout of cash of $8,800. Debits have to equal credits in every transaction, so we could force this at this point in time. And cash is an asset, increases on the debit side. We have less cash, so it's a credit. Sales tax payable. Most of us know what sales tax is. It's levied on any retail sales. It is collected from the customers to be remitted to the state. Because of that, the business has a liability on the books until they pay that money to the state. They collect it, but they don't pay it to the state until the end of the month. So in this case, if we were recording a sale from Home Depot that totals $200,000, and it's a cash sale, Home Depot collected an additional 5% in sales tax. 5% times $200,000 equals $10,000. And they would record that day's sales as they bring in the cash. They got the actual cash. Cash increased by $210,000. Sales increased by $200,000. And the liability of sales tax payable increased by $10,000. They will then pay this sales tax payable at some point in time, and when they pay this, they would debit their sales tax payable for the $10,000 and credit cash as they wrote their check to pay this, or it may be paid as an EFT withdrawal from their bank account. Accrued liabilities result from expenses incurred but not yet paid. This was what we talked about a lot in Chapter 3. Some very common accruals are salaries and wages payable, interest payable, and income taxes payable. We accrue them, but we don't pay them. We don't pay our income taxes until we may have to do deposits quarterly. Otherwise, we would pay our income taxes at the end of the year if we were a business. So payroll liabilities. These are also called employee compensation. They're a major expense for almost all businesses. Many different forms. There are salaries, which include you get paid for so much a week, or so much a month, or so much a year, not an hourly rate per se. A wage would be an hourly rate. A commission is that you're paid a % of your sales. And a bonus is something that is awarded on top of either your salary, wage, commission, or bonus, or your salary, wage, or commissions. And it's an additional money coming in. It is still taxable. So I wanted to use this illustration here to help you understand how you would record payroll expenses and liabilities. So we would have a salary expense, income tax payable, FICA tax payable, and our salaries payable. I want you to have a slight understanding of what these numbers would represent based off of what your check looks like. Get me a pen here. Oops. So a salary expense would be what you see on your check stub as gross wages. Gross wages for the company. Your income tax payable, this is the amount of federal income tax, or FIT, that is withheld. If you see FICA on your check stub, that is your Medicare and Social Security taxes, or OHID, all totaled together. Usually we would show these in separate accounts in our payroll records. It's easier to reconcile if we have our Medicare tax separate than our Social Security taxes. And then the payable here would be the net pay on your paycheck. There can be many, many, many deductions from your checks. You can have garnishments. You can have donations like to United Way. You can have medical insurance deductions. You can have contributions to your 401k. Any of these deductions would show up as a payable on the company's books because they have withheld that money from your check, but it is not the company's money. It is a liability. They owe it to someone else. Payroll liabilities. And so I just said this, that the salary expense represents a gross pay. It creates several payroll liabilities. Companies must also pay employer payroll taxes. What does this mean? It means that with the payroll employer taxes, there is a match for Social Security and Medicare. And depending on the state you live in, your work may pay 100% of the federal and state unemployment tax, or some states charge or withhold part of that from the employee checks, and the employer pays the rest. And all of those taxes have to be collected out of the employee's checks or deducted from the employee's checks. And then, except for the matches, and those matches mean the employer pays those taxes in addition to what you collect out of your paycheck. It's kind of interesting. Let's pop up a spreadsheet here and look at just a little illustration real quickly. If we had a gross paycheck of $400, and we were going to take out 10% of, just a second, and we were going to withhold 10% of federal income tax, that would be $40. And then if at the rate of $400, if we are withholding Medicare is 1.45%. So we would say our 400 times 0.0145. Social Security is 6.2%. So that's plus this times 0.062. So this is gross. This is federal income tax. This is Medicare. This is Social Security. We would have some state in Indiana. State happens to be 3.4%. So if you live in Wayne County, or your county tax is 1.5%. So this would make our net pay be $309.80. That's if we have nothing else withheld from our checks. For our company, they would have to match our $24.80 here, the $580, and they would also have to pay, in Indiana, they have to pay a percent up to the first $7,000 that you earn. So if your experience rate was 3.5%, say, if you had to pay 3.5% unemployment, then the company would have to add to the tax liabilities the $580, the $24.80, and the 400 times 0.035 for unemployment. So this is, the employee is paying you $400. You're bringing home $309. The employer is paying you $400. You're bringing home $309. And it's actually costing the employer, in this case, this is without health insurance, remember, $444.60 to hire you. I like to show this because, when we look at this, this would be if you were working 40 hours a week, this would be a $10 an hour job. It's costing the company $11.12 an hour to hire you. And again, as I said, that's without benefits. So those are, it's just a little simple illustration to help you understand when you're on the management side, suddenly when people want more money, it's more than $1 an hour raise if you get $1 an hour raise. So it's interesting to look at it from that perspective because I think sometimes employees don't realize that. We also have talked about unearned revenues. We talked about those when we were doing adjusting entries as well. They are called deferred revenues, and they are revenues that are collected in advance. We may, it could be a deposit or an advance, but the business actually has received the cash and they still need to provide the good or service to the customer, and that's what makes it a liability. We owe the customer the goods or service. Here's an example for Southwest Airline. I don't know how many of you fly, but when you fly, you typically book your ticket in advance, and the company does not earn that until you have actually been provided the flight. So on December 15th, Southwest Airlines collected $300 for a round-trip ticket from Dallas to Los Angeles. On December 28th, the customer flies. So what happens on December 15th? Well, Southwest gets the money. They get the cash for $300, and they record this as a liability. In this case, they're calling it air traffic liability. Then on December 28th, they have now earned half of that money because it was a round-trip ticket. So they reduce their liability by $150 and record it as ticket revenue. When you fly back on your return trip back to Dallas, they record the other half, and reduce the liability to zero. So here is an illustration about a publisher. When you buy magazine subscriptions, you typically pay for them, or newspapers or whatever you're subscribing to. It could be Comcast as far as that's concerned. Anything that we pay for with a subscription period, then we need to record that. The company would need to record that as an unearned revenue, and then they transfer it to a revenue as it is earned over a period of time. So Wortham Publishing completed the following transactions for one subscriber during 2014. They sold a one-time subscription collecting cash of $2,400 plus sales tax of 9%. They remitted and paid that sales tax to the state of California, and then they made the necessary adjustment at year-end. So this started on October 1st, and their year-end is December 31st. So we need to journalize these transactions. On October 1st, we received the cash of $2,400 plus 9% sales tax, and we recorded that as an unearned revenue and sales tax payable. The unearned revenue was the $2,400. The sales tax payable is the $216. On the 15th, we remitted the sales tax. So we reduced our liability for sales tax payable by the full amount and paid cash. On the 31st, we needed to record the adjusting entry of how much revenue we have earned up to this point. We will reduce our unearned revenue by 3 months of the year's subscription, or 1/4. So $600. And $600. 2,400 divided by 4 is 600, or 2,400 times 3/12, which equals 1/4, equals $600. The current portion of long-term debt, also called current maturity or current installment, it is a long-term debt, often paid in installments. Again, this would be like you were paying off your mortgage or paying off your car. The amount of the principal payable within 1 year is the current, and then the company reclassifies the amount from a long-term to current. Basically, you will always, until the very last year, you'll have 1 year's worth of your payments listed as current, and the rest will be long-term. Another current liability that we must estimate is a warranty expense. Remember, we have estimated several different expenses up to this time. We estimated our bad debt expense. We estimate our depreciation expense. Those are estimates, and they're offset on the financial statements with those estimates. So when we have an estimated warranty payable, it is a contingent liability. We sell something that we know may need repairs, and so we sell it with a warranty. It could happen. So the estimated warranty payable is a warranty period that may extend for 90 days to a year. The company must record a warranty expense in the same period that the business records the sales revenue. That is the expense recognition principle we talked about a lot. You must record expenses in the period of which they are incurred. Match them with the revenue to make it the matching principle. Contingent liabilities have a potential liability that depends on future outcomes of the past events. If it's for accounting, we must accrue them, disclose it, or neither if it's unlikely. So we'll look a little more deeper at contingent liabilities as we move forward. To record the estimated warranty, we're going to look at Black & Decker. They made sales of $100,000 for our product subject to product warranties. Assume that in the past years between 2 and 4% of their products proved to be defective, so they're going to estimate that 3% of their sales will require repair or replacement. They record that 3% by taking 3% times the $100,000 in sales to come up with $3,000, and estimated warranty payable is your $3,000. So your expense, again, expenses increased on the debit side. Your warranty payable is your liability account. Liabilities increase on the credit side. Then when we have a cost incurred due to a defective product, we know we do not go back and charge it to expense again. We've already expensed it. We have just now identified part of what that would be, part of the items it would be, and we record that by reducing our estimated warranty payable account. And in this case, we use parts to fix it, so we have less inventory, or we replace the defective products in their entirety. So contingent liabilities, if it depends on how likely it is that they will happen. So if something is probable and we can estimate what its value might be, we accrue it. If it's reasonably possible, we disclose it in the notes to the financial statement. And if it is something that is remotely possible, we don't do anything. So, there's two things with the probable. We either accrue it if we know or can estimate. This could be, how do we estimate a potential probability or a potential cost of a probable liability? We go out and we research other court cases, basically, or research other insurance settlements that have happened for something similar. If a company vehicle driven by one of their employees is involved in an accident and is determined to be the company driver's fault, and there's an injury or a death in that situation, then the company is going to be sued. And they would go out and they would, as I say, research, their attorneys would research other companies to see, okay, what was the settlement in another case similar to this, or in other cases similar to this? And if the settlement were $1 million, and they would estimate that's what the settlement would be, and they would accrue that $1 million. If there had never been any case like it that they could actually pull a reasonable estimate, then they would just disclose in the financial statements and say, in the notes to the financial statements, and say that they have this situation of an accident and they're just not sure what the settlement will be, but they expect there to be a settlement. If it's just reasonably possible, we do the same thing. We say, we're pretty sure there's going to be a settlement in this case, but we don't know how much. But if it's just really unlikely that there would be a lawsuit or a settlement, they don't do anything. They don't disclose that to their shareholders. Accounting for bonds payable, notes payable, and interest expense. Bonds are the debt of the issuing company. Bond certificates state the company's name, the principal, the face value, maturity value, par value, the maturity date, the interest rate, and interest payment dates. None of these terminologies should be new to you. We just did a chapter where we were looking at bonds receivable. When we were looking at bonds receivables as investments, all the calculations behave exactly the same. The only difference is now we're the person who is borrowing the money instead of the person who is investing in that company. Keep in mind that every time a company has an accounts payable on the books, another company has an accounts receivable. If a company has a bond receivables on the book, like we did in Chapter 8, they will have another company will have a bonds payable on their books. Interest computes exactly the same. Maturity value is exactly the same thing. Par value is the face minus or the stated rate of interest. Maturity value is the date that it's due. The interest rate will be stated, and it will also tell you the payment dates. Like I say, we looked at this exactly in the previous chapter. There are different types of bonds. There are term bonds, secured bonds, unsecured bonds, and serial bonds. If you get a chance, and I hope that you're actually reading each of your chapters, but I hope that you go and you look on page 495 in your book and you look at what a bond certificate would look like, and you will notice that it actually does tell the issuing corporation what the maturity date is, the principal of the bond, the annual interest rate, and how often the interest rates will be paid, or interest will be paid. Serial bonds are a series of payments or installments. So the company might borrow $10,000, and they may pay back $1,000 of it each year. That would be serial, a series of payments. Term bonds mean they all mature at the same time. So if you had a 10-year bond for $10,000, you would pay it all back at the end of the 10 years. A secured bond simply means that it would be like your car loan again, where you had borrowed and the car was the security, or on a mortgage, your house is the security, whereas unsecured is just a borrow of money. You don't have anything that secures it. Again, we learned in Chapter 8 that bonds have quoted prices. They're quoted at a percentage of their maturity value, or they may be. If we look at a bond that has a 1,000 face value and its quoted price is 100, that means it is sold at $1,000 and it is sold at par. It's sold at face value. If we have a quoted price of 101.5, that bond is going to be sold for 1,000 times 1.015, and that is sold at a premium. And if a bond is sold at a discount, it will be less than 100%. In this case, it was sold at 88.375 as this quoted price, and therefore you would pay for this, or the company would get for this bond, $883.75 when it was sold, and that would be a discount. So again, to put some thought process behind this, a bond is sold at a premium when it's above face value. It's a discount if it's below face value. A premium has a normal credit balance. A discount has a normal debit balance. Market price decreases toward maturity value, and the market price increases toward maturity value for a discount. So the whole idea when we talked in Chapter 8, and we talked about how it levels the playing field, so that if a bond indenture was written up at a set interest rate and then the market rate has increased or decreased, it protects the company so they can still sell that bond. So interest rates determine bond prices. Bonds are always sold at market price. You figure the bond's present value. To do that, we use the present value in Chapter 8 to compute how much we would pay if we were investing in a bond. That same amount would be what was recorded if the company was selling it, that present value. The stated interest rate, or it can be called the coupon rate, is printed on the bond, and it determines cash interest paid to the bondholders. The stated interest rate does. The market interest rate, or you sometimes hear it called the effective interest rate, is demanded by investors for loaning money, and it varies by the minute. Interest rates change. So we have interest rates determine bond prices. If we assume a stated rate of 8%, so the bond rate is 8%. If the market rate is 6%, then we will sell that at a premium, because investors would be getting cash interest of 8% on their money, so they are willing to pay more than the face value of the bond. At 8%, it would sell at face value or par, and if it were 10% market rate, that bond would sell at a discount, because if I can get 10% on my money, why would I invest on something only paying 8% if there was not a reason to level that out? So if I pay less than the full price of the bond and then I'm still being paid the 8%, it levels the playing field out so that I would invest in that bond, or potentially invest in that bond. So we'll look at a couple examples here. If Southwest Airlines has $50,000 of 9% bonds payable that mature in 5 years, we're going to assume that these bonds were issued on January 1st and that the issue price is they issued them at par. I had to go back and read. If we issue at par, we record them simply at face value. We got $50,000 cash and $50,000 bonds payable. We will pay them back. We will pay interest at 9% on $50,000 every year, and then we will pay them back the $50,000. If this is a semi-annual interest payment, and we want to record the first semi-annual interest payment, then we would take the $50,000 times 4.5% for the 6 months, or we could take $50,000 times 9% times 1/2 for our interest payment. Our interest expense would be $22.50, and this would be a cash payment interest of $22.50. Okay, they need to accrue because the interest isn't due until January 1st, but their year end is December 31st. So again, it's going to be the $22.50, but it will be interest expense and this time interest payable because they have not paid it. They will not pay this until January 1st. On January 1st, then they will reduce their interest payable and pay out their cash for the $22.50. And then they pay this bond off by reducing the bond payable by $50,000 and paying the cash of $50,000. That's at par. If this were issued at a discount, $96,149 is the amount that they got for the bond. That's how much cash they would have collected. The bond itself is $100,000, so the discount is going to be the difference between $100,000 and the bond payable and the cash of $96,149, or a discount of $3,851. A little look at the accounting equation. Our assets have increased. Our liabilities have increased by $96,149. Look at how it would be on the balance sheet. Our carrying value would be $96,149. Our bonds payable less the contra account of discounts on bonds payable. So how do we figure the interest expense when we've had a discount? Well, we know it was issued, so we have a 5-year life bond. It's going to pay interest 10 periods, right? If the market interest rate at the time the issue was 10% annually, 5%, the face was 9%, 4.5%, and the issue price was $96. Our semi-annual payment is going to be $10,000 times 9. This is the cash interest times 612, or we could take $10,000 times 4.5% to get $4,500. However, the interest expense for this first 6 months, and this number may blow your mind away just a little bit, is actually $4,807 because we have the $96,149 times the 10% times 1/2 to get the $308 difference. That is actually the reduction in the discount as we move forward through this. So what is the interest expense? We need to do a bond amortization schedule to do this. In Chapter 8, we looked a little bit at straight line amortization. With straight line amortization, it would, if we had this discount of $38.51, we would have just simply divided the $38.51 by 10, and we would have used the same amount each year. When we are using the effective interest method to amortize our discount, we do this just a little, well, not a little, I mean, we do it a lot differently. We have our cash interest calculated, which is $4,500 each time, because the cash interest that's paid out to the investor is the face value of the bond times the face interest rate. In this case, it was $100,000 times 4.5% or $45,000. That's the cash that you're paying out each time. However, our interest expense is higher than that because we need to amortize this discount down. Our goal is to bring the carrying value of this bond up to its face value by the end of the 10-year period, and that's what we're showing here. So our interest expense, the second column here, this is actually your carrying value of $96,149 times the market rate of interest of 5%. That's where the 4807 comes from. 96,149 times 0.05 or 5%. Then the next step it tells us is we need to find out what our discount amortization is. Our discount amortization is $307 in this case, the 4807 minus the 45. And then what is our balance in our discount? Our discount balance decreases. It's now $35,44. And our new carrying value is $100,000 minus $35,44. To do the next period, we still have the $4,500 because the cash interest is the same, but on the 1,115 interest expense column, it's the new carrying value of $96,456 times the market interest rate of 5%, and you follow that process down. Excel is perfect for this. You can go in and you can put in your formulas and then you just drag it down. One thing you will have to notice is that the bottom last interest expense number may have to be adjusted due to the rounding that is done in the problem to make you come out to exactly the face value of the bond. And that's all right because that number would not be material. It's not going to make a difference to the decision makers. Okay. So our interest expense, as we showed, I talked through it already. This is just illustrating it again. Very detailed. Your book is very detailed about this. So what happens to the 3851 balance of the discount over the life of the bond? It decreases as it is allocated to interest expense through amortization. This 3851 is additional interest expense over and above the stated interest paid. Amount of interest expense increases as the bond carrying value increases. This is something that I encourage you not to get too caught up in. Go to your book, look up the formulas, figure out how they're doing it, and then just repeat that. If you would end up in a job where you needed to do this, you could easily pull an example of an amortization table and duplicate that for the business. I have never worked a real-world job at this point in my life where I've had to amortize bond interest. I've done similar type calculations with amortizing payments, but never bond payments. A couple little charts to show how it evens out. And then the journal entry itself is interest expense 4807, discount on bonds payable is 307, and our cash interest is the 4500, the check that our investor would get. To accrue the interest, again, we wouldn't be paying it, so it would be interest payable. And then on January 1, we would pay that interest with cash. So what would Southwest Airlines 2014 income statement and year-end balance sheet report for these bonds? They're going to report on their income statement the interest expense, and on the balance sheet they will report the interest payable under their current liabilities, and under their long-term liabilities they'll have the bonds payable at $100,000 face less the discount to get the carrying value at year-end of $96,779. And this is just another example of doing the exact same thing, a discount. So if you want to work through this, that would be good experience. Okay. If we have partial periods, we have to calculate those as well for year end. If we issue a bond at a premium, we had just gone through the example at a discount. So if we issue the bond at above face value because the market interest rate is lower than the base interest rate, then we would record the cash at the amount we got. The bond payable is still $100,000 in this case, and we have a credit to bonds payable because the carrying value of our bond at this point in time is more than the face value. So remember with the discount how our goal was to bring the value of the carrying value up to $100,000. When we issue a bond at the premium, the goal is to bring the carrying value of the bond down to the face value. So it behaves the opposite. So same illustration, and we'll get to the amortization table. We would still have the $4,500 cash interest paid out. We would be multiplying our 4% times our face. We would subtract B from C instead of C from B to get a positive number. And then we subtract D from E to get our new premium balance, get our carrying value, repeat the process. And as in the other problem where we were going, again, up to $100,000, in the premium we're going down. Click you through these that explain it very much in detail. You can pull these slides right from the multimedia library at my accounting lab, and these illustrations are also in your textbook. So the journal entries, premium would be reducing on the debit side, pay out the cash interest, couple slide illustrations. So then, as I had discussed a little bit earlier, we have done the straight line amortization method in Chapter 8. So it's less precise way to amortize bond discount or premium. It divides the bond discount or premium into equal periodic amounts over the bond's term. The amount of interest expense is the same for each interest period. And this method allows for its amounts differ insignificantly from, it is allowed if the amount differs insignificantly from the amounts determined by the effective interest method. Back to the old, is it material? Would it make a difference to our decision makers or to the investors if they paid more or less interest on an annual basis or expensed off more or less interest on an annual basis? So straight line, July 1st, it will be that every time. We could potentially retire bonds before they mature. Would we, if we had a debt out there that was a bond payable, might we want to do that? Well, we might want to do that if we have high interest-bearing bonds and we can borrow money at a lower interest rate, if we can do the early payoff. And so we may want to do our bond indentures with the callable feature so that we can pay those bonds off at a prearranged price. It can, of course, result in a gain or loss on that sale. So if I'm Southwest Airlines and I retired $300 million of debenture bonds, assuming the unamortized discount is $30 million, assume that the bonds are callable at 101, so a predetermined price of what I'll pay for those bonds if I call them back in early. If the market price of the bonds is 99, will Southwest call the bonds at 101 or purchase them for 99 in the open market? Market price is the better choice because the market price is lower than the call price. Retiring the bonds at 99 results in a loss of $27 million, computed as follows. So their bonds are going to retire $300 million, less that discount on those bonds to give us $270,000 million carrying value. The market price is 99 cents times $300. And the loss on the retirement, the bonds payable would be 27. Convertible bonds and notes. You might invest in a convertible bond at some point in time, and what this means is that the bondholders can exchange the bonds for stock. And what does that mean? Well, stock is ownership, right? Investors benefit because it's a guaranteed receipt of principal and interest on the bonds, and it is a potential for gains on stock. So if Southwest has convertible notes payable of $100 million, note holders convert stocks into, let me start that again. Southwest has convertible notes payable of $100 million. Note holders convert notes into 4 million shares of Southwest's common stock, which is $1 par on May 14th. So what does that entry look like? We have convertible notes payable of $100 million and common stock. It was $1 par and we got 4 million, so 4 million times $1. And then we would have paid in capital in excess of par on the books for $96 million. The difference between debt and equity financing is that equity is ownership and debt means we're just borrowing the money and we'll pay the money back. So there's 3 main ways to finance operations. One is retained earnings of the company. If we need to buy something and we have enough in retained earnings, we can use that money to buy our any long-term asset that we need, or we can use it to do a bonus to our employees. As long as we have enough cash that's there from the profitable operations. This is a low-risk strategy. We can do this. We can self-finance through retained earnings if we've got the money. We can issue stock. The issuing stock, it creates no liabilities or interest expense. It's less risky than debt, but it is more costly because we have given up that ownership. And issuing bonds or notes payable does not dilute control. The owners don't give up ownership, but there is an increased risk because you've got to be able to meet those interest payments and the principal payments as they come due. And interestingly enough, debt and equity can affect your earnings per share. So the amount of a company's net income for each share of its common stock. Suppose Southwest needs $500,000 for expansion. They have a net income of $300,000 and 100,000 shares of common stock outstanding. Management is considering 2 financing plans. Plan 1 is to issue $500,000 of 6% bonds payable, and Plan 2 is to issue 500,000 shares of common stock for $500,000. Management believes the new cash can be invested in operations to earn income of $200,000 before interest and taxes. Okay, so either way, they're going to get their $500,000, right? So let's look at how this affects the relative earnings per share. The net income before expansion was $300, right? They're going to borrow $500,000 at 6%, or they're going to issue 50,000 shares of stock for $500,000. They expect to gain income before income tax of $200,000. If they borrow the money, they will have interest expense of $30,000, $500,000 times 6% to yield them $170,000 before income tax. If they issue the shares of stock, they still have $200,000. Income tax expense of 40% would be $68,000 on the $170,000 or $80,000 on the $200,000. Their projected net income then becomes on line 6, $102,000 if they borrow, $120,000 if they sell stock. The total company's net income would be the difference between $402 and $420. If they borrow, their earnings per share is going to show at $402. If they sell stock, their earnings per share is going to show as $2.80. So if earnings per share is an important component of making a decision whether to invest in a company or not, they just shot their stock value. We can look at a couple more ratios. We're getting close to the end of the slides here for tonight. The leverage ratio is debt ratio, total debts divided by total assets. It measures the proportion of total liabilities to total assets. We may look at the leverage ratio of total assets divided by total stockholders' equity. This is known as the equity multiplier. The ratio shows the company's total assets per dollar of stockholders' equity. We also want to look at the times interest earned ratio. This helps you to decide if you can meet interest payments as they come due. Can we cover the interest expense? It's also called the interest coverage ratio. It's the times interest earned ratio. Again, operating income divided by interest expense. And then a few other long-term liabilities that we may want to talk a little bit about. One of those are the differences between long-term leases or capital leases versus operating leases. Operating leases are probably how you rent your home. You sign maybe a year's lease, but you pay your rent monthly. A capital lease has a few other items entailed in that. So with an operating lease, you have the right to use the asset. The owner of the property takes the risk and the rewards of owning that property, and the renter records the rent expense, or the lessee. With a capital lease, the lessee has the right to use the asset, so it's the same. However, with this, the lessee assumes the risk and rewards of ownership. So if there's expenses to the leasehold, then the person who's paying the lease has to fix it, not the owner. And the lessee capitalizes the leased asset and records a long-term liability. Remember with capitalized, we talk about we capitalized long-term assets. We talked about we capitalized interest that is incurred during the building of a project. It becomes part of the cost of the asset. So that capitalized is included in the price and then depreciated out for our long-term asset. Well, here we are going to record all of these items as a capitalized asset, a capitalized liability, and then we will adjust out accordingly. So they will record their depreciation expense. In order for a lease to be considered a capital lease, it must transfer the asset to the lessee at the end of the lease term. It must contain a bargain purchase price. The lease term is 75% or more of the estimated useful life of the leased asset. So if a building has a normal useful life of 20 years, then the lease would have to be for at least 15 years. And the present value of the lease payments is 90% or more of the market value of the leased asset. So when it's leased, you've got to do the calculation that present value to make sure that the present value is at least 90% of the market value. Another type of long-term liability that we might look at are pensions and post-retirement liabilities. These are expenses recorded while employees work for a company. The cash contributed into a pension plan assets, and obligation grows for future payments to employees. These can be underfunded, which means the plan assets less than obligated are held by the company, or overfunded, the plan assets are greater than obligation. When the plan assets are less than obligated, then sometimes the employer can't pay out the pensions like they're supposed to. So how do we report liabilities on the balance sheet? We want to make sure that we report the current maturities for long-term debts under current assets, and that we are reporting the long-term debt under the long-term section on a classified balance sheet. And then disclosing the value or the fair value of long-term debt. Generally accepted accounting principles, or GAAP, require companies to report fair value of their long-term debt. Fair value of publicly traded debt based on the quoted market prices fluctuate with interest rates and overall market conditions, and can either exceed or be less than their carrying amounts. And the last thing we're going to look at here is how are we going to present what we've just looked at on the statement of cash flows. And all of these items would be financing activities. They would be payments of long-term debt, repurchases of common stock. If we are spending money, we would put it on our cash flow as a negative number. If we are bringing money in, it would be a positive. And that's the end of the chapter. I've made my computer mad. Okay, finally. I thought I would look at something here. I want to remind everyone that the withdrawal date for your courses is April 11th. If you are struggling in your courses, you probably need to speak with your instructor, try to get some dialogue going, see if you have an opportunity to still be successful in the course. If they, after that conversation, if you believe that dropping might be in your best interest, it's still very good to contact your academic advisor and speak with them and see what the ramifications of dropping a class would be, or withdrawing from a class versus the ramification of failing a class. So those dates are coming up. Pay attention to that. I always advocate that you should keep trying and stay in the classes as long as possible if you're struggling, and especially in required courses like Accounting 101, where if you do need to retake it, then you've learned as much as you can learn this time through. Another thing that I wanted to point out to you is if you go to class sessions, now if your instructor has all your class sessions open, you may want to start alleviating your fear over the final exam. If you go to session 15, you will see that there is a review guide. I say that. There's a final exam study guide that will give you very guided study material. The final exam is proctored in this class, so you will need to study and then set up a proctor. If you don't have a proctor site set up yet, you'll want to get that done, ready to take your final exam. That I wanted to point out that you may want to look at that as we move forward. Make sure you start your work early. I saw that my accounting lab is going to be down for a couple of hours, mostly in the middle of the night, in the next on Saturday morning, I believe. So pay attention to that. Don't get yourself caught up in not being able to access my accounting lab when you need. If you have any questions when you're working through my accounting lab, you can use the Help Me Solve It with your instructors. They will respond. It's a really good way to get guided answers by using Help Me Solve It. You might have, your instructor could have online office hours. There may be tutoring that you can take advantage of, either online or face-to-face at your local campus. So start those dialogues and talk if you're struggling at all. I know students either tend to do really well or they tend to kind of get lost in the system and not even know what quite to ask to get help. So hang in there, work hard, do your best, and I'll see you next week.